In this last part of the lecture, I want to say a little bit about measuring costs and profits, at least from an economic point of view. What we're thinking of is using cost and profit information to assist in the decision-making process that the firm has to, at some point, undertake. So we need to think, how do we want to measure costs? And the way that we measure costs is, of course, going to influence the way that we measure profits. Profits, of course, are just going to be the difference between revenues and costs measured in a certain way. Well, once we've got that information, then we can use it to assist in certain kinds of decisions. And we'll see in a minute what kind of decisions I'm thinking about. Well, the way that we normally think about costs is the way that accountants would write them down. And the same goes for profits as well. So I'm just going to define accounting profits as the difference between revenues and explicit costs. And by explicit costs, I just mean the kind of monetary payments that an accountant would record for purposes of making an accounting statement. Now, from the point of view of an economist, there are some costs that are missing that really should be taken into account. Now, all costs involve some sort of opportunity that's given up. And that includes explicit costs, but it also includes costs that are not monetary. But nevertheless, they're still they still represent things that we've given up. So what we want to think about is the value of the next best alternative that we had, some other opportunity that we gave up to do what we're doing. So the opportunities that we give up involve real costs, but these costs are implicit. That is, they're not actually monetary costs. And so they're not going to get recorded by accountants, and for a very good reason. But from the point of view of economic decision-making, we're going to want to think about those. Well, this probably seems all very abstract so far, so let's just consider an obvious and concrete example. Suppose that somebody decides to go to university full-time to get an MBA. Well, that person is going to be paying tuition, perhaps airfare if the person has to travel to the place where he or she is going to study. But there are also other kinds of costs which are implicit costs. So the student in this case has given up a salary that he or she could have earned during that year when they're doing their MBA studies. Well, that's not something that they actually paid, like the tuition payment, but it's a real cost nevertheless. And I'm sure that every MBA student has given that some thought when deciding whether or not to invest in that degree. Let's think of a business example. Suppose we've got a farmer who plants corn on his fields this year, but had another opportunity. Let's say he could have planted soybeans instead. So by planting corn, he's given up the income from that opportunity. So that was a real opportunity cost. So as I'll say a little bit about in a minute, when the farmer wants to think, did I do as well as I could have in planting corn, he'd want to consider what would have happened if soybeans had been planted instead. Well, let's think of one more example. Let's go back to our publishing company example. Suppose it's got some capital invested in this business, and the accountants say that that capital is earning a rate of return of 5%. So we could ask ourselves a question. Is that an adequate rate of return? Should we be happy with that? Or would it be better if we did something else instead, if our capital was employed elsewhere? Well, the answer to that is that it really depends on what the other opportunities are that we have. In other words, what is the rate of return available elsewhere? How does that compare to the 5% that we're earning? So what I want to do is just define profits from an economist's point of view. So we want to think of this thing that we'll call economic profit as distinct from accounting profit. And we'll define that as revenues minus economic costs. And those economic costs include not only the explicit costs that an accountant would think about, but they also include any relevant implicit costs, like the kind of opportunity costs that I've just mentioned. So what's the point of measuring profit in this way? Well, I think economic profit helps to answer a very important question, because the firm has to ask itself, are we doing as well as our next best opportunity? If we're doing just as well, or perhaps better, then that next best opportunity is not going to be particularly attractive. That would be a situation in which profits are positive. So the firm is doing better at what it's doing than any other alternative. Well, given that, let's just ask a question. Suppose the firm is earning 0 economic profits, as I've defined them here. Is 0 economic profits acceptable to the firm's owners? Just pause the video for a moment and think about that. The answer that you should have come up with is that 0 economic profits is okay. The firm is doing just as well as its next best opportunity. So there'd be no point in really doing anything else. It's like our corn farmer is doing just as well as he would have done if he'd planted soybeans instead. So there's no regrets. The farmer is not going to leave the corn industry and join the soybean industry. So from now on, any reference that we make to profits in this course is economic profit. It's this sort of broad definition of profits that includes both explicit costs and implicit costs.